Dr. Babasaheb Ambedkar Open University.
Welcome friends to the discussion on accounting equation. In this part, we are going to look at golden rules of accounting, and some authors or the people call them traditional rules of accounting. These are the rules of debit and credit based on types of accounts. We have already seen one type of accounts like the asset, liabilities, revenue, etc. in the last discussion. Now we will look at another classification of types of accounts in this part. Let's look at these types of accounts as well as the rules of debit and credit. We had earlier, based on the accounting equation, seen the rules of debit and credit. Now we are looking at another types of accounts wherein the accounts are divided into three parts: real accounts, personal accounts, and nominal accounts. Some authors also call it golden rules of accounting for these three different types of accounts. The real accounts are the accounts of goods and assets. I'll give you some examples of the real accounts, like your cash account or cash balance is your asset, bank balance is your asset, land, building, stock, these are all goods and asset account. What is the rule of real account? The rule is debit what comes in, credit what goes out. So when goods or the asset comes into the business, we debit that account. For example, when we purchase a furniture account is debited because furniture comes in. When we purchase goods or the purchase account is debited because the goods come in. At the same time, when we sell goods, the goods goes out. Debit what comes in, credit what goes out. This is the rule. So for any asset or for any goods, whenever the goods or asset come into business, we debit that account. Whenever such goods or asset goes out of the business, we credit that account. Apart from these real account, the next type is personal accounts. So you must be clear about what is personal account. And here also I would suggest, my dear friends, that you find out 50 examples of real accounts, 50 examples of personal accounts. I'll tell you a few of them. Personal accounts are the accounts of persons. But please note, my dear friends, usually we understand by person as only a natural person. But from the viewpoint of accounting, the person includes, apart from the natural person, artificial or legal persons also. Sometimes notional person, representative personal accounts are also there. That also we'll discuss. I'll give you some examples of the personal accounts before we go for the rule relating to the personal accounts. These examples are Mr. Anil Patel's account. Anil Patel is a person, is a natural individual, is a natural person. Apart from these natural person, there could be artificial person or legal entity. For example, Mr. Anil Patel starts a business in the name of ABC Corporation. Then this ABC Corporation, which is a firm or an enterprise, also known as a person from the viewpoint of accounting, which is to be kept in mind. If you start a company, it is a legal entity, ABC Limited. That ABC Limited is also a person. So accounts of whether natural person or artificial person or legal person, they are all known as personal accounts. I'll give you some more examples. Dena Bank's account, State Bank of India's account, these are all again personal accounts. Sardar Sarovar Narmada Nigam Corporation Limited, that is also a personal account. Even if you keep an account of a government of Gujarat, that is also a person account, because it is person's account. And persons could be an individual, it could be an association of person, it could be a partnership firm, it could be a proprietary firm, it could be a private limited or limited company, or it could be any other artificial juridical person that would be branded as person, that would be grouped under the personal account. The accounts of such persons are known as personal accounts. And for personal accounts, my dear friends, the rule is debit the receiver, credit the giver. Now, if you Mr. A brings a capital. Mr. A is a person. We call it a capital account, but here Mr. A brings in rupees 20,000 into the business. And we had seen in the earlier example that when proprietor or the owner brings capital, capital account is credited, or Mr. A's capital account is credited. Now, why this account is credited? Because the account which is being affected is Mr. A's account. Mr. A is a person. What is the rule of personal account? Debit the receiver, credit the giver. Why are we crediting Mr. A's account? Because Mr. A is a giver of cash of rupees 20,000 in the example that we have already seen. If Mr. A brings a capital of 20,000 rupees into business, we will continue with this example so that there is a continuity and you understand it in a better manner. Mr. A brings a capital of rupees 20,000. So we credit A's capital account because A is a person, he is a giver, and we have to credit giver's account, credit the giver. And in this very transaction, if we look at the another account which is being affected is cash. Cash is a real account. What happens to cash? Cash comes into the business. And we have already seen real account. What is the rule? Debit what comes in, credit what goes out. So is cash coming into business? Yes. So cash account will be debited. Therefore, we pass journal entry, or how these transactions are recorded in the books of accounts. Friends, I am telling you, we usually write journal entries like this: cash account debit to A's capital account credit, or just capital account credit. So cash account, being a real account, is debited because cash comes in. The another account which is affected is Mr. A's capital account, which is a personal account, where the rule is credit the giver. Because Mr. A is a giver, we are crediting Mr. A's account. The third type of account in this category is nominal accounts. Nominal accounts are the accounts of expenses and incomes. Expenses include losses, my dear friends. And income is either revenue. We also call income as revenue, or gains. The rule is, the examples of expenses and income we have already seen. Let us recapitulate. Expenses are salary expense, telephone expenses, rent expense, office expense. These are all expense account. Incomes, commission income, sales income, discount received, dividend received, etc. These are all incomes. The rule for these nominal accounts is debit all expenses and losses and credit all revenue, incomes and gains. Suppose we get a commission of rupees 200 in cash. One account which is being affected is cash account. The other account which is being affected is commission account. Cash comes in, it is a real account, so we will debit cash account. Commission is an income, credit all incomes. So commission income account has to be credited, and therefore we pass a journal entry. We say cash account debit to commission income account credit, or just commission account credit. As you become familiar with the accounting terminologies, you will understand that commission income is a revenue income, because you earn that money. You are earning that money. When you receive that money, it is no, you are not incurring any liability. You don't have to pay back that money to somebody. Because you have served somebody, because you have given services, you have got that income which is known as a revenue income. So if you have a clear understanding about these golden rules of accounting, based on these three types of accounts also, friends, you can pass accounting entries, and that will help you understand the accounting. But we had discussed another types of classification of accounts, like asset, liabilities, capital, income and expenses. The modern approach, or some of the countries or some of the authors, they follow that this is the easier way for students to understand, or anybody who is a novice in accounting, for them this is an easier approach. You are free to decide about, by both the methods or by both the types of accounts, you will be able to understand the concept well. Whatever way you feel is convenient to you, you can go ahead and start understanding. What is important is not remembering, my dear friends, but understanding, because it is said that whenever you read to remember something, there are all chances that you will forget. But my dear friends, if you have read to understand something, and if you have understood the concept, you will never forget it, even if you want, because the things which you have understood, you are not able to forget it, even if you want, my dear friends. So you can feel free to go for any of these types of accounts and understand the rules and then apply them while you are practically dealing with recording of the transactions in the books of accounts of a business enterprise. The rules for asset account is debit the increase in asset and credit the decrease in asset. Naturally, as I told you earlier also, asset plus means increase in asset is what? Debit the increase in asset, and the rest of the thing, is a natural corollary. As I told you, if the increase in asset is debited, naturally decrease in asset would be credited. The second, let us understand the rule for liabilities. Credit the increase in liabilities and debit decrease in liabilities. So if your liability increases, that liability account has to be credited. If your liability decreases, the liability account has to be debited. We will understand them with the help of some examples in the later part, but let's first understand these rules. The third type of account is capital. Again, it goes, if you remember the equation, asset is equal to capital plus liability. It is on the right hand side, or capital and liabilities are on the same side. Therefore, the rule that you will apply would be same as the rule which is applicable to liabilities, and therefore credit the increase in capital and debit the decrease in capital. For the income and expenses, the rule is credit the increase in income. We had discussed commission income, it increases, so commission account is credited, credit the increase in income. But if there is a decrease in income, that has to be debited. For example, you had received some commission, but now you have to return a part of the commission to somebody, that is a decrease in commission. At that time, commission account can be debited. Debit the increase in expense, salary, when you pay, it increases salary, therefore salary account debit. Rent, when you pay, rent account debit, because it is an expense which increases. Credit the decrease in expense. Remember these 5 rules, or the 5 types of accounts, and the rules of debit and credit relating thereto, and let's understand some of the transactions with the help of some real life examples. 1. Purchased machinery of ₹1,000 from ABC Corporation on credit. What will happen when you purchase a machine? You get an asset. Your asset increases. Your machinery, suppose it was 0. Now it is a machinery of ₹1,000, which increases. And on the other hand, what is the impact? Your asset increases. On the other hand, because you are buying this machine on credit from ABC Corporation, you are incurring liability to ABC Corporation. So your liability increases, and therefore asset increases, liability to ABC Corporation decreases. The second example is, owner brings ₹2,000 as capital in business, capital increases, cash or the asset increases, that we have already discussed. Received commission income of ₹3,000 by cash, commission income increases, your cash asset increases. Paid salary of ₹4,000 by cash, your salary is an expense, it increases, and your cash asset decreases. Like this, you can take hundreds of the transactions and understand what is the impact on asset, on liability, on capital, on expense, on income, and then decide whether that account will be debited or that account will be credited. And we are also going to discuss practical aspects by again looking at some more illustrations or the transactions or the real life transactions that will help you understand this in a better manner. Till then, thank you very much. Thank you, friends.
Dr. Baba Sahib Ambedkar Open University.